So, imagine a soldier, right? They're stationed at a remote forward operating base.
Okay, yeah.
And suddenly, their radar interface pings. There's an incoming hostile drone. And we aren't talking about something massive. It's small, cheap, maybe a couple $1,000s off the shelf, but it's modified, like strapped with explosive.
Right, a classic asymmetric threat.
Exactly. And, 10 years ago, the protocol for that might have been to track it, scramble a whole localized defense system, and fire a surface-to-air missile at it.
A missile that costs, what, $500,000?
Yeah, $500,000 just to take out a $2,000 drone.
Yeah.
I mean, the cost asymmetry of that exchange is it's a logistical nightmare for any military.
Oh, absolutely. It's unsustainable.
But today, that same soldier, they pull out their tactical radio, tap an application interface, and basically they download a software patch.
Just right there in the field.
Right there.
Yeah.
The radio broadcasts a really specific localized radio frequency pulse, severs the drone's command link, and the threat just drops right out of the sky.
Wow.
And the cost to defeat it's basically just the electricity used to power the radio's battery.
That is incredible.
It is. And that reality, this idea of modern software-defined defense, it sits at the absolute center of the earnings call we are unpacking today for you.
Yeah, and it's a profound shift, in how we think about aerospace and defense companies in general.
Because they've always been so hardware-focused, right?
Exactly. For decades, this industry has been defined by heavy metal. I mean, bending steel, pouring concrete, building these massive platforms, fighter jets, aircraft carriers, over 10 or even 20-year development cycles.
Yeah, it's historically been a very slow-moving space.
Right, but what you just described with the radio, that's an industry being forced to operate at the speed of Silicon Valley.
Which is a totally different ballgame.
Totally. And for the retail investor, you listening at home looking at this sector, the challenge is really figuring out which companies are actually making that transition and which ones are just using buzzwords to appease Wall Street analysts.
Which brings us to the specific stack of sources we are tearing into for this deep dive. We are looking at L3Harris Technologies.
Ticker symbol LHX.
Yes, LHX. Yeah. And specifically, their Q2 2026 earnings call. Now, L3Harris has been branding themselves for a few years now with a very specific and honestly very aggressive corporate moniker.
Right. They call themselves the trusted disruptor.
The trusted disruptor. So, okay, let's unpack this. Our mission today on Talk Tickers is to cut through that corporate gloss, skip the jargon, and look strictly at the financial and operational data they just reported.
To see if that title actually holds any weight.
Exactly. Are they actually disrupting the legacy defense industrial base? Or is this just, clever marketing masking a company that just happens to be benefiting from a global surge in defense spending?
That is the big question.
So let's start with the hard data, the headline numbers. When you look at the metrics from this second quarter, what jumps off the page for you?
Well, the initial read is undeniably strong. I mean, the data management delivered leaves very little room for bearish interpretation, at least on the surface.
Okay, should be with the numbers.
We are looking at top-line revenue that hit $5.9 billion for the quarter.
Wow, $5.9 billion.
Yeah, which represents an 8% jump year over year.
And in the defense sector, that's huge, right? Because contracts are usually locked in years in advance.
Exactly. Revenue recognition is typically a really slow burn, so an 8% organic top-line growth is a formidable number.
Right.
But, the profitability metrics, like the actual efficiency of turning that revenue into shareholder value, that's where the narrative really solidifies.
Okay, so how did earnings look?
GAAP earnings per share came in at $3.13. That is a 28% increase from the same period last year.
Wait, hold on. A 28% jump in earnings per share on just an 8% increase in revenue.
Yep.
That immediately tells me they are expanding their margins.
Significantly. They aren't just selling more volume. They are making way more profit on every single dollar they bring in the door.
That's exactly right. But for anyone managing their own portfolio, you know that net income and EPS can sometimes be obscured.
Oh, yeah. Accounting maneuvers, depreciation, amortization, all those non-cash charges.
Exactly.
Yeah.
The metric that usually strips all that noise away is free cash flow.
Right. Cold, hard cash.
Well,
and how was their free cash flow?
It was the standout metric of the entire report.
Really?
Oh, yeah.
Yeah.
It hit $771 million for the quarter.
Wow.
Which is a 37% increase year over year.
37%?
Yes. And to contextualize why that matters for you listening, free cash flow is the actual unencumbered cash the business generates after it has paid for all its operating expenses and, maintained its capital assets like factories and equipment.
It's the lifeblood of a company.
Exactly. You cannot fake cash in the bank.
Yeah.
And a 37% increase in free cash flow provides management with massive optionality.
Like what does that let them do? Well, it dictates their ability to pay down debt, raise the dividend, or repurchase shares without having to go out and tap into external credit markets.
Which is huge when interest rates are high.
Exactly.
I want to pause on the revenue pipeline for a second, though, because the earnings transcript spent a significant amount of time detailing a specific metric, the book-to-bill ratio.
Ah, yes, the book-to-bill.
Yeah, they reported a 1.2x book-to-bill for the quarter and a 1.3x on a trailing 12-month basis.
Right.
Now, for you listening, if you aren't spending your days reading dense defense procurement documents, this can sound like super obscure jargon.
It definitely can.
So let's translate this. What exactly is a book-to-bill ratio?
The book-to-bill ratio is arguably the single most important leading indicator for any company operating on long-term contracts.
Okay, break it down.
The book represents the new orders coming in, basically the total dollar value of the contracts they are signing today.
Right, the new business.
Exactly. And the bill is the revenue they're actually recognizing and billing to the customer right now for past orders.
Okay, so you divide the two.
Yes, by dividing the two, you get a ratio that tells you whether the business is expanding or contracting. A ratio of 1.2x means that for every $1 of revenue they recorded in the quarter, they added $1.20 in new future business.
So it's like a popular restaurant, right?
Oh, that's a good way to look at it.
Yeah, think of a 1.2x book-to-bill ratio as the equivalent of the hostess taking 12 new reservations for every 10 tables the waitstaff clears.
Right. The line out the door is actively growing faster than they can seat people.
Exactly. And as an investor owning that restaurant, you're thrilled because you know your future revenue is secured.
Secure and growing.
And that line out the door translates directly into their total backlog, which they announced has reached $42 billion.
A $42 billion backlog is just staggering.
It's massive.
It provides a massive buffer against short-term economic volatility. Like, even if global procurement suddenly froze tomorrow.
Just zero new orders.
Right, zero new orders. L3Harris still has $42 billion of contracted work to churn through.
That's years of revenue locked in.
It is. It gives management incredible visibility into their future cash flows, allowing them to plan their capital expenditures and their hiring with a degree of certainty that, frankly, most commercial sectors just do not possess.
Okay, but this is where I have to play devil's advocate for a minute.
Go for it.
Because a $42 billion backlog and 37% cash flow growth don't just magically appear on a balance sheet.
No, they don't.
And the narrative Wall Street loves to tell right now is that defense contractors are just sitting back and catching cash as governments panic over geopolitical instability.
Right, the macro tailwind theory.
Yeah, I mean, with conflicts abroad, rising tensions in the Pacific, and basically a bipartisan consensus in Washington to maintain a wartime footing for the industrial base, budgets are expanding everywhere.
They definitely are.
So I have to ask the hard question. Is L3Harris actually operating a fundamentally better business today, or are they just the lucky beneficiaries of a macroeconomic environment that is lifting all boats?
Honestly, that is the most critical question an investor can ask regarding the sector right now.
Because if it's just luck.
Exactly. If a company is merely riding a macro tailwind, their margins will eventually compress when that tailwind dies down.
Right.
However, the data presented in this earnings call strongly points to an internal operational turnaround.
Okay, where specifically?
Specifically within a division that was the subject of intense scrutiny just a few years ago.
Oh, you're talking about Aerojet.
Yes. The primary engine of this current growth traces back to L3Harris's acquisition of Aerojet Rocketdyne, which now forms the core of their Missile Solutions division.
I remember when that acquisition was announced 3 years ago, Wall Street hated it.
They absolutely despised it.
Yeah, analysts were openly questioning the move. They were arguing that L3Harris paid a massive premium for a deeply troubled asset.
And it was troubled. Aerojet was notorious at the time for supply chain bottlenecks, delinquent deliveries, and terrible margins.
Right. And L3Harris was mostly a communications and sensors company. The consensus was they had no business trying to integrate a heavy manufacturing propulsion and missile company.
And To be fair, the skepticism was completely warranted at the time. I mean, integrating a propulsion company is vastly different from building software-defined radios.
Oh, night and day.
But CEO Chris Gubasik dedicated a significant portion of this call to outlining how the business they operate today bears almost no resemblance to the one they purchased.
Really? So it wasn't just talk?
No, the turnaround isn't anecdotal. It's fully quantified in the data.
Okay, what do they actually do?
Well, since taking over, they completely overhauled the leadership structure, enforced strict manufacturing rigor, and this is key. They multiplied their investments in research and development and capital expenditures by a factor of 10.
10 times the capital investment.
10 times.
That implies the previous ownership was essentially starving the business of the funds needed to modernize.
They absolutely were.
So what did that massive infusion of capital actually yield? What are the results?
The results are striking. First, total delivery volume is up over 60%.
Wow, 60% more product going out the door.
Yes. Second, and this is perhaps most importantly for their relationship with the Pentagon, they have essentially eliminated all delinquent deliveries.
That is a huge deal.
It is. When they bought the company, late deliveries were a chronic structural issue. Today, they are actually meeting the schedule.
Okay, but anyone can speed up a factory if they throw enough money and overtime at it.
Right, right. But here is the metric that proves this isn't just macro luck or brute force. Their operational efficiency has improved by 22%.
Wait, a 22% efficiency improvement while simultaneously pushing 60% more product out the door. That is the definition of scaling effectively. I mean, in manufacturing, when you push volume that hard, things usually break. Efficiency drops because you're paying crazy overtime or dealing with supply chain friction.
Usually, yes.
So doing both simultaneously increasing volume and efficiency, that requires a fundamental change in how the product is actually built.
It does. And that leads us to what they were calling the arsenal of freedom.
I saw that in the transcript. It sounds like something out of a movie.
It does sound theatrical, but it's very real. They are opening a brand new factory next month for GMLRS, that's Guided Multiple Launch Rocket Systems. And based on the transcript, this facility sounds like a complete departure from legacy defense manufacturing.
How so? Like, what's different about it?
Well, it's highly volatile chemicals. The traditional method involved mixing the propellant, pouring it into casings, moving it into these massive curing ovens where it sits for weeks.
Weeks?
Yeah, weeks. And then manually inspecting it for microscopic air bubbles.
Why air bubbles?
Because an air bubble in a solid rocket motor can cause a catastrophic failure upon ignition. It can explode in the tube.
Oh, right. That's bad.
Very bad. So that manual inspection was a severe bottleneck for the entire defense industry. But the new Arsenal of Freedom facility completely reimagines this workflow.
Yeah, the integration of automation here is what really caught my attention when I was reading through the notes. They are deploying robotics to physically move the solid rocket motors from station to station.
Which removes humans from the most hazardous environment.
Exactly. And they have automated the mixing, the casting, and the curing processes. And instead of those slow manual inspections, they're using automated X-ray inspection cells.
It's brilliant. Furthermore, they are overlaying all of this physical automation with artificial intelligence designed to analyze the manufacturing data in real time.
So the AI is monitoring everything.
Yes. The AI monitors the curing parameters, it predicts potential defects before they even happen, and optimizes the yield.
That is wild.
It is. By removing the manual bottlenecks and applying advanced analytics, L3Harris expects this single facility to cut manufacturing time by 50% while simultaneously doubling their total production capacity.
Cutting the build time in half completely reshapes the economics of the missile business.
It really does.
I mean, it turns a sluggish, capital-intensive grind into a high-velocity production line.
Exactly. And clearly, the primary customer noticed this operational discipline because the Department of Defense did something highly, highly unusual.
Oh, I know what you're going to say.
They didn't just award L3Harris a standard contract to buy more rockets. They made a direct $1 billion financial investment into L3Harris's manufacturing capacity.
$1 billion?
Yeah.
Straight into the factories.
Yes. That is an extraordinary vote of confidence and a massive data point for investors to consider.
Because it's not revenue for product, it's capital investment.
Exactly. The government is effectively acting as a direct capital partner here, injecting $1 billion to accelerate L3Harris's facility expansions by 12 to 18 months.
Wow.
The Pentagon recognized that the industrial base was dangerously fragile. And rather than just hoping industry would take on all the capital risk to build new factories, they leveraged government funds to ensure L3Harris could scale immediately.
Which is amazing for the stock because it completely de-risks the expansion for the shareholder, right?
Mm-hmm.
While guaranteeing the government gets the volume it desperately needs.
It's a win-win.
Okay, so we have spent a lot of time on the heavy metal here, the rockets, the factories, the propulsion. But if we go back to the hook of this deep dive, the whole trusted disruptor strategy isn't just about building missiles faster.
No, it's much broader than that.
It's about bridging the gap between hardware and software. So I want to dive into the rate shield example the CEO brought up on the call, because I think it perfectly illustrates how the margin profile of a defense contractor could fundamentally change over the next decade.
Yes, Rate Shield is a perfect case study. It's a counter-UAS unmanned aerial systems jamming solution, and it is entirely software-based.
Completely software. So to put the mechanics of this into perspective for the listener, imagine a piece of hardware a soldier already carries, like a smart software-defined radio.
Okay.
In the past, hardware was static, right? A radio was just a radio. If you wanted a device to jam a drone's frequency, the Pentagon would have to issue a multi-year contract to design, manufacture, and field a brand new bulky jamming device.
And that takes years and millions of dollars.
Right. But with a software-defined radio, the hardware is essentially a blank slate. It's controlled by a field-programmable gate array.
A computer chip, basically.
Yeah. So when the soldier downloads the Rate Shield application to that existing radio, the software commands the hardware to alter its radio frequency waveforms dynamically.
It just changes what the radio does.
Exactly. It turns a standard communication device into an electronic warfare weapon instantly over the air.
That is just phenomenal. And the CEO actually mentioned observing a live demonstration of this, where a threat drone was neutralized purely through a software application deployed on existing tactical gear.
Which is exactly the scenario we talked about at the top of the show.
Yes. And the strategic leverage here is immense. I mean, you bypass the entire logistical nightmare of manufacturing, shipping, and maintaining new physical hardware.
And training people on new hardware.
That too. You provide immediate, updatable agility to the warfighter on the front lines.
But let's look at this through the lens of a retail investor, because Talk Tickers is all about the financials.
Right.
If you are selling hardware, your margins are constrained.
Right.
Right. You have the cost of materials, labor, shipping, warehousing.
Heavy fixed and variable costs.
Exactly. But if you are selling a software update, your marginal cost to distribute that code to 100,000 existing radios is practically zero.
It's effectively zero.
Which introduces the concept of recurring high-margin software licensing revenue to a sector that has traditionally been valued on low-margin metal bending.
It entirely changes the margin profile of the company. If L3Harris can continue to successfully blend this highly efficient automated hardware production with these high-margin updatable software solutions, they begin to look a lot less like a legacy prime contractor.
And more like what?
More like a diversified technology company, like a Silicon Valley firm.
Which sets up a really fascinating contradiction in this earnings call.
Okay, what do you mean?
Well, we've established that the Missile and Propulsion Division is executing a textbook turnaround, right?
Yeah.
Efficiency is up, deliveries are soaring, capacity is doubling, and they just secured $1 billion capacity investment from the government.
Yes, all true.
If a division is performing that spectacularly well, standard Wall Street logic dictates you spin it off into its own publicly traded company immediately to unlock that value. Let the market price it at a premium.
Ah, the IPO.
Yeah. Yet management used this exact call to announce they are delaying the highly anticipated IPO of this exact division until mid-2027.
Right.
So why hold back? If the engine is running this hot, why not take it public right now?
It's a great question, and it was arguably the most heavily scrutinized segment of the earnings call by institutional analysts.
I bet.
But CEO Chris Gubasik was remarkably transparent about the rationale for the delay, and it really centers on a disciplined approach to value creation rather than just chasing a short-term stock pop.
Okay, unpack that for me. What's driving the decision?
The decision hinges on two converging factors.
Right.
First, current market conditions. And second, the internal scaling trajectory of the business itself.
So when you say market conditions, we are talking about the broader appetite for initial public offerings right now, which has been undeniably volatile.
Extremely volatile.
Right. You don't want to launch a highly anticipated defense spinoff into a market that is just going to assign it a depressed multiple right out of the gate.
Precisely. Management assessed the current IPO window and determined that the broader market would not assign a valuation that accurately reflects the intrinsic value of the automated, highly efficient machine they are building.
Okay, that makes sense. But what's the second factor? You mentioned the internal scaling trajectory.
This one is even more compelling from a data standpoint. The company revealed on the call that they are actively negotiating over $20 billion in new contracts, specifically for this missile and propulsion division.
Wait, let me stop you right there to make sure the scale of that number lands for the listener.
It's massive.
The total backlog for the entire L3Harris Corporation across all divisions is $42 billion.
Right.
And they're negotiating $20 billion in new work for this one division alone.
Yes.
That is almost half the current total backlog just in the pipeline for this one unit.
And if they successfully secure those negotiations, it would effectively triple the backlog of the missile business prior to a spinoff.
Wow. Okay, yeah.
From a strategic management perspective, taking the division public today would honestly be financial malpractice.
You'd be leaving so much money on the table.
Exactly. You wait until those contracts are inked, the backlog is maximized, and all those new automated factories like the Arsenal of Freedom are fully online and demonstrating their high margins.
You present Wall Street with a fully realized cash-generating juggernaut in 2027 rather than a work-in-progress turnaround story today. It makes complete sense when you put it like that. I mean, you don't sell your house the week before you sign a new 10-year lease that triples its rental income.
Perfect analogy. You secure the asset first.
Right. Furthermore, they noted that the heavy cash requirements needed to finish building out the rest of these planned facilities, they don't actually hit the balance sheet in a significant way until the 2027 to 2029 timeframe.
Right, so they aren't even starved for the cash an IPO would generate right now.
Exactly. So that leads directly into an important discussion about their overall capital strategy. Because if they aren't forcing a premature IPO to raise funds, they're relying on their own robust internal cash flow.
Which, as we established, is up 37%.
Right. But they are also utilizing a very unconventional tool for a legacy defense prime to accelerate their technology roadmap. And that is their venture capital arm, Shield Capital.
Ah, yes. Shield Capital.
And I was really hoping we would get to this. Because when you think of legacy aerospace companies, you think of massive internal R&D departments moving at a glacial pace.
Bureaucracy, red tape, 10-year timelines.
Exactly. You do not typically see them operating a nimble, agile VC fund.
How exactly is L3Harris utilizing Shield Capital?
Well, about 4 years ago, L3Harris established a strategic partnership with Shield Capital, committing roughly $50 million across two of their funds.
Okay.
And the primary objective here is to gain early privileged access to emerging dual-use technologies.
Let's define dual use for the listener. Right. Dual use means technology being developed primarily for the commercial sector, things like advanced artificial intelligence, machine learning, data analytics, and autonomous systems.
Stuff Silicon Valley is already building.
Exactly. But it's tech that also has immediate, highly relevant defense applications.
The logic there is unassailable.
Yeah.
I mean, if there's a nimble startup in Silicon Valley, right, composed of 5 genius engineers who have just written a revolutionary AI algorithm for autonomous drone navigation.
L3Harris shouldn't spend 5 years and $100 million trying to replicate it internally.
Exactly. They just invest in the startup through Shield Capital, get a seat at the table, and integrate that cutting-edge tech directly into L3Harris platforms immediately.
It fundamentally forces a culture of speed upon a traditionally slow-moving organization.
It's like outsourcing your R&D to the fastest innovators on the planet.
The CEO actually emphasized that this partnership allows them to make investment and integration decisions in a matter of days or weeks.
Instead of years.
Right. It bypasses the suffocating layers of corporate review that usually stifle innovation in large defense firms.
And beyond just the technological advantage of doing that, these strategic investments are maturing, right? They are starting to generate actual financial gains.
Yes, the financial returns from these VC investments are positively impacting their overall earnings per share.
They are acting like a tech incubator. It is a brilliant way to future-proof the product pipeline.
It really is.
But speaking of the future, Past performance and turnaround stories are great for context. But investors are ultimately buying future cash flows.
Always.
So let's pivot to the forward-looking guidance management provided for the rest of 2026. Did the confidence we are seeing in the backlog translate into their actual projections?
Oh, it's translated into substantial across-the-board upgrades.
Okay, let's hear the numbers.
Based on the aggressive execution in the first half of the year, management raised their full-year 2026 revenue expectations by $200 million.
Okay, what's the new target?
They are now targeting a top-line range of $23.2 billion to $23.7 billion.
Got it.
To put that in perspective, that implies organic revenue growth of roughly 8 to 10% for the year, which is exceptional for a mature company of this scale.
8 to 10% top-line growth is strong, yes, but the profit guidance is the piece of data that really forces you to pay attention here.
Definitely. Management raised their earnings per share guidance by a full 40 cents.
40 cents a share.
Yes, bringing the new expected range to $11.80 to $12 per share.
Okay, but wait, there's a catch there, right?
Well, to truly appreciate the strength of this upgrade, you have to understand the underlying math, yeah.
Because it wasn't just a straight 40-cent raise.
No, this 40-cent raise is highly impressive because the core business actually had to absorb a 20-cent headwind to get there.
Okay, unpack that headwind for the listener. Where is that 20-cent drag on EPS originating from?
L3Harris is currently in the final stages of divesting, basically selling off a majority interest in their commercial space propulsion business.
Right, getting rid of non-core assets.
Exactly, and that transaction is slated to close in August. But here's the thing, when you sell off a revenue-generating division mid-year, you permanently lose the earnings that specific division would have contributed to the bottom line for the remaining quarters.
Obviously, yeah. You don't own it anymore.
Right. And management quantified that lost profit from the space division at roughly 20 cents per share.
Okay, so let me do the math here. The remaining core business, the radios, the missiles, the sensors, is performing with such high efficiency that it completely erased the 20-cent loss from the divested space division.
Yes.
And then generated an additional 40 cents of profit per share on top of it.
You got it.
Wow. So if they had simply held on to that commercial space business, they effectively would have been raising guidance by 60 cents per share.
Precisely. That indicates incredible margin resilience in their core operations.
It proves the internal engine is running incredibly hot.
It does, and that operational efficiency is generating a massive stockpile of capital. In fact, the chief financial officer, Ken Sharp, noted on the call that they expect to have roughly $4 billion in cash on hand before executing any debt paydowns or additional share repurchases.
$4 billion in dry powder. That is a phenomenal asset to have.
It is, but as you know, it can also be a liability if management misallocates it.
Absolutely. From the perspective of a retail investor evaluating the long-term health of this stock, what is the specific capital allocation strategy for that $4 billion? Like, what are they actually going to do with it?
CFO Ken Sharp outlined a very prudent, very balanced framework for deploying that capital. It basically falls into 4 pillars.
Okay, what's pillar 1?
First and foremost, they are prioritizing organic growth by fully funding the expansion of 60 new buildings and automated facilities across their portfolio.
Right, the arsenal of freedom and everything else. You have to feed the beast first.
Exactly. That is the engine for future revenue.
Okay, what is the second priority?
Debt reduction. They are targeting approximately $1.8 billion in upcoming debt paydowns.
$1.8 billion. That's a huge chunk.
It is. But in a macroeconomic environment where interest rates remain elevated, retiring debt is an incredibly smart move. It immediately reduces their interest expenses.
Meaning more of their operating profit will flow directly to the bottom line as net income in the coming years.
Exactly. It boosts EPS without having to sell a single extra product.
Lowering fixed costs is always a win for the shareholder. So that's facilities and debt. What about direct returns to the investor?
That forms the third pillar of their strategy, dividends.
Okay.
L3Harris intends to maintain their impressive 24-year streak of consecutive dividend growth.
Wait, 24 years?
24 years. They are 1 year away from achieving dividend aristocrat status.
Oh, wow.
Yeah, it's a highly coveted classification that requires a quarter century of consistent dividend increases.
That is rare air in the defense sector.
Very rare. And finally, the fourth pillar. Whatever excess cash remains after the facilities, the debt, and the dividend, it will be deployed into share repurchases.
Buybacks?
Yes, reducing the total float of outstanding shares and thereby artificially increasing the proportional ownership and value of every remaining share held by investors.
It's just a fundamentally sound conservative checklist. I mean, reinvest in automated capacity, pay down expensive debt, aggressively grow the dividend, and buy back shares.
There's no frivolous M&A or reckless expansion in that plan at all.
None. So as we zoom out and synthesize this entire earnings transcript, what is the bottom line for the listener sitting at home, looking at their brokerage account, trying to decide if LHX deserves a place in their portfolio? What's your verdict?
When you aggregate the data, the 37% surge in free cash flow, the 22% margin expansion in a historically troubled division, the strategic implementation of AI in their manufacturing base, and this highly disciplined capital allocation, this earnings call flashes a very strong bullish signal. Strongly bullish. L3Harris is proving they are not just passively drifting upward on a wave of global defense spending. They are actively executing a complex operational turnaround.
They are earning their keep.
They really are. And, we didn't even touch deeply on their space domain dominance today, where they are actively taking market share.
Oh, right. Like the AMD T3 contract.
Exactly. Being the sole company awarded all 5 contracts for the AMD T3 missile tracking satellite constellation, which is a critical mesh network for tracking hypersonic threats.
So they are positioning themselves at the bleeding edge of the most vital national security domains.
Yes. The Aerojet acquisition, which was universally panned as a massive risk 3 years ago, has undeniably been transformed into a cornerstone of their future growth.
The data proves it.
It does. And the decision to delay the IPO of that division rather than rush into cash in demonstrates a management team that is prioritizing long-term structural value over just, quarterly stock manipulation.
It is the hallmark of a mature, confident leadership team. They are negotiating from a position of absolute strength right now.
They are.
I completely agree with your read on this. The data absolutely supports the trusted disruptor narrative. Which leaves me with a final provocative thought for you listening to consider as you evaluate not just L3Harris, but the entire defense sector.
Okay, lay it on us.
Throughout this deep dive, we have explored how this company is behaving increasingly like a nimble technology firm, rather than a traditional metal bender, from venture capital partnerships to AI-driven robotics. But the most crucial shift we talked about is the software.
The Rate Shield example.
Exactly. When a product like the Rate Shield drone jamming software can be deployed onto existing hardware via a simple application update, the fundamental economics of defense contracting change.
It completely replaces a rigid physical supply chain with instant, scalable digital distribution.
Yes. So here is the question you need to ask yourself as an investor looking at the next decade of this sector. If software-defined architectures become the absolute norm, where military capabilities are upgraded via cloud downloads rather than building entirely new physical platforms, will Wall Street eventually be forced to reevaluate how they price these stocks?
That is the multi-billion-dollar question.
Because currently, defense contractors trade at relatively modest multiples based on low-margin hardware sales. But if the bulk of future value is derived from recurring, near-zero marginal cost software licensing,
shouldn't a forward-thinking defense prime eventually command the premium valuation multiples of a high-margin software-as-a-service tech firm?
Exactly. Should they be priced like SaaS companies?
Yeah.
Because if that paradigm shift in valuation occurs, a company like L3Harris, which has its foot firmly planted in both the automated hardware production and the software disruption worlds, could be severely undervalued by today's metrics.
It is a really compelling thesis. I mean, the market rarely prices in a fundamental shift in business models until it is already overwhelmingly obvious in the cash flow statements.
By which time it's too late to get the alpha.
Exactly. So keeping an eye on that software to hardware revenue mix will be vital for anyone holding this stock long term.
A massive shift to keep on your radar.
Yeah.
Well, thank you for joining us on this deep dive into L3Harris's Q2 results, and we will see you next time.